Hello friends, Berkshire Hathaway held recently its annual shareholder meeting. And Warren Buffett always says some interesting things during those meetings. But sometimes it is even more interesting when we analyze what he's trying not to say. And this year he really wasn't very good at hiding that he is preparing for a crash, for some sort of big, meaningful change in the economy and the markets. And he touched on this subject a number of times. First, when he was asked about owning the biggest amount of cash ever and not deploying it for investments.
This question's from Johan Halen, who writes, "You're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?"
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but prefer it. But if we had 10 billion, I wouldn't basically see many more opportunities than we found. Now, it's true that something like Japan we could have done. But, it isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
So he likes the fact that he can get around 5% from treasury bonds. That is basically 5% risk-free return, so really not bad. But he also points out that it is not a real reason for gathering cash, because he would prefer to have a lot of cash around even if he would only get 1% from it. So there has to be another reason. Well, he says that he can't find good things to put his money into. So basically, he thinks that the prices are too high right now. It doesn't make sense to him to buy companies when they cost so much. Now, that reason for gathering cash seems important. But that is not all. When Warren was asked why he sold a substantial portion of his Apple shares, he mentioned a few things that could help us understand his outlook on the future.
Given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, but we have sold shares, and I would say that at the end of the year, I would think it extremely likely that we will have Apple as our largest investment. But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive. And one thing that may surprise you, but almost everybody I know pays a lot more attention to not paying taxes than I think they should. We don't mind paying taxes at Berkshire, and we are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings. And they can change that percentage any year. And the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give. And I think that higher taxes are quite likely. And the government wants to take a greater share of your income or mine or Berkshire's, they can do it. And they may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it. And we always hope at Berkshire to pay substantial federal income taxes. I would really hope with all that America's done for all of you, it shouldn't bother you that we do it. And if I'm doing it at 21% this year and we're doing it at a higher percentage later on, I don't think you'll actually mind the fact that we sold a little Apple this year.
I believe it is so important to point out that he said that taking into account the current condition of the market, he does not mind a huge pile of cash lying around. So he's waiting for the conditions to change. He is waiting for prices to go down. He also said that he believes that it is possible that the taxes will go up. So he decided to sell some stock of Apple not only to get cash while the prices are high, but also to avoid future increased taxes. Well, I don't really buy this explanation. It may be true, but there is more to it. First, he says that he wants to pay higher taxes, but then he says that he sold Apple to avoid higher taxes. That does not seem logical. That is why I believe it is super important to read between the lines during those meetings, because there is more than meets the eye. He also points out many times that he does not believe in timing the market, and he does not concentrate on macroeconomics. But in this case, he is predicting tax rates, and he clearly states that considering what is happening in the world and on the markets, he prefers to have cash. And okay, 5% risk-free return is nice. Maybe the taxes will go up and that is okay, but there is something missing here. Well, I believe the answer is in the next clip.
I think that when you're handling the sums that we will have, you've got to think very strategically about how to do very big things. And I think Greg is capable of doing that. I think I've missed a lot of stuff in the past, so I'm actually wiser about doing that now. I would do it better this time around than 2008 and 9 if something akin to that happened. But it won't be exactly like 2008 or 9. You can be sure of that. But you also can say that there will be times when having huge sums available extremely quickly, maybe it'll be once every 5 years, maybe it'll probably be more like once every 10 years or something. But as the world gets more sophisticated, complicated, and intertwined, more can go wrong. And there's no sense going through here and exploring the possibilities of the different things that could happen. But we do want to be able to act when it happens. And I think the chief executive should be somebody that can weigh buying businesses, buying stocks, doing all kinds of things that might come up at a time when nobody else is willing to move. It wasn't that people didn't have money in 2008. It's that they were paralyzed, and we did have the advantage of having some capital and a willingness to an eagerness even to act, and a government that in effect looked at us as an asset instead of a liability. And I think that all of those qualities will be even more important as our capital pile grows. And so I think Greg may have even more fun than I had in a period when extraordinary things were happening, and we were the logical place to go. You never know whether it'll be next week, next year, next decade, but it won't be a century from now, that is for sure.
So we see very clearly that Warren and Berkshire is preparing for a crisis that could be similar to 2008. They want to have as much cash as possible because when the prices will go down, he will be like a child in a candy store with a wallet full of cash. When there is panic, the stocks go on sale, and people with cash and will to act can make a lot of money. And that is exactly the moment for Berkshire to act, because then they can really move the needle and invest all those billions of dollars. And because he knows it is impossible to predict the future, he points out that the crash may come in a week, a year, or a decade, but he is sure that it will come. Because crashes always eventually come after the stock prices are too high for a long period of time. And Berkshire is going to be ready. But how should we build our wealth in such times? Well, first of all, we should probably think a bit about what the best investor in history is saying and doing. And maybe, as Monish Pobrai would say, cloning his actions could be a smart move. But actually, during the shareholder meeting, there was a question that focused exactly at that point.
Towards the end of 2018, you mentioned that you guarantee you could make a 50% annual return if you had to start again with under $1 million. The question is, if tomorrow you woke up in the body of
your body,
20-year-old American.
Your body. But that's fine.
And your name was now Warren a la carte. And you had some money to invest on a full-time basis. What method or methods would you use to achieve that return? Would it involve flipping through 20,000 pages of Moody's manual or similar publications?
Yep.
Or finding, to find cigarettes? Or would it be hunting for great companies at a fair price as Mr. Munger would? Or would it be a combination of both?
To answer your question, I don't know what the equivalent of Moody's manuals or anything would be now, but I would try and know everything about everything small, and I would find something. And with $1 million, you could earn 50% a year. But you have to be in love with the subject. You can't just be in love with the money. You really got to just find it like essentially like, people find other things in other fields because they just love looking for it. A biologist looks for something because they want to find something. And that's built into. I don't know how the human brain works that much, and I don't think anybody understands too well how the human brain works. But there's different people that just find it exciting to expand their knowledge in a given area. I know great bridge players. I know great chess players. Actually, Kasparov came to Omaha and met Mrs. B. I've had the luck of meeting a lot of people that are unbelievably smart in their own arena and do some unbelievably dumb things in other areas. So all I know is the human brain is complicated, but it does its best when you find out what your brain is really suited for, and then you just pound the hell out of it from that point. And that's what I would be doing if I had a small amount of money and I wanted to make 50% a year. but I also wanted to just play the game. And you can't do it if you don't find the game of interest, whether it's bridge or whatever it may be, chess, or in this case, finding securities that are undervalued. But it sounds to me like you're on the right track. I mean, anybody that'll come all the way to this annual meeting has got something in their mind other than bridge or chess. So I'm glad you came, and come again next year.
I like that advice a lot, because he's not only saying study businesses, understand industries, expand your knowledge, so all the things we are trying to do here on this channel, but also he touches on a very important point, that we must enjoy the game. That it should not be about the money, but about the game of investing, about challenging ourselves and finding fulfillment that way. Money is more like a score of this game, and if we play because we love the game, we have a bigger chance of getting a better score in the long term. Well, I think it is only fair that Warren should end this video.
Just in case you know what my advice to myself has been during this period. So we only got 3 questions or whatever it is. But thank you very, very much for coming. And I not only hope that you come next year, but I hope I come next year.